Welcome to the Morrows Private Wealth Annual Market Update for August 2026. My name is Chris Molloy and I'm the CIO for Morrows Private Wealth. Today I will discuss our outlook and high conviction investment themes as we move into 2027. This chart shows the major asset class returns for the financial year ending 30th of June 2026. Defensive assets such as cash and government bonds were low returning, with Australian listed property down 2% and global listed property up 15%. Australian shares are up 6% and global shares are up 23%, with emerging markets the best were up 35%. The benchmark Vanguard Balanced Fund was up 8% for the period. The chart on the left shows global share market returns for the 6 months to 30th of June. Markets started positively before falling 10% into the Iran war, and then rebounding strongly on multiple ceasefire announcements and also the positive narrative around AI and technology advancements. The chart on the right shows the historically strong double-digit earnings growth that markets have paid more attention to, particularly out of Asia on the back of AI tailwinds and demand for more compute power. Our last half-yearly update was generally upbeat, with global growth positive, central banks looking to cut interest rates, financial conditions were accommodative and inflation was falling. That said, market valuations were expensive and we had geopolitical risks bubbling away in the background. Things have changed today. Global growth is anemic, central banks are biased to increase in interest rates, financial conditions are accommodative, but inflation risk is to the upside. Despite this, market valuations are still expensive and geopolitical risks are elevated. The chart on the left shows that inflation in Australia is well above the RBA's target band, which has seen multiple interest rate rises with potentially more to come. As a result, consumer and business confidence has slumped, as seen in the chart on the right. On the left shows that US inflation remains well above the Fed's target of 2%, and whilst the Fed remains on hold with interest rates, the pressure to raise rates is increasing. Similar to Australia, the chart on the right shows US consumer confidence is feeling the impact of higher inflation. Inflation remains a major concern as it impacts interest rates and the outlook for whether markets move higher from here or experience a major correction. Geopolitics, Iran, oil prices, the AI boom all pose upside risks to inflation, and this chart shows that historically, whenever US inflation pushes through current levels, a significant market correction has occurred. On the flip side, AI is a major tailwind for markets. The chart on the left shows the amount of capital expenditure by US tech firms on AI-related investments. This fuels global corporate earnings, market sentiment, and rising valuations. But there's a caveat. The right shows the free cash flow of these major US tech companies turning negative, meaning they are spending more on AI than they are earning from it. If this trend continues, then we should expect markets to re-rate these tech giants down. But if they can start generating revenue from their AI spend, then the bull market continues. So what does this mean for investors? AI is a tailwind and it's real. The question is whether it can be monetized. If the tech spend on AI generates revenues, then the cycle continues. But if stagflation, meaning low growth and high inflation, lies ahead and global central banks raise interest rates, it might put a pause to this AI cycle boom that results in a material correction in equity markets and particularly expensive growth assets that are priced for perfection, not interest rate hikes. Our portfolios are positioned with the following asset allocation tilts. We're hedging US dollars at current levels, we're neutral to cash, and we are underweight government bonds. We are underweight to all listed credit markets, property markets, share markets, given current valuations and risks. In the listed equity markets, we prefer resources over banks and small caps over large caps. We are overweight to unlisted private debt, private infrastructure, and private equity within our liquid and illiquid alternative asset classes. Venture capital is also a high conviction strategy going forward. This chart shows that investors on average are as bullish as they've been in the last 20 years. Does this signal complacency in the market or that the market can continue to rally higher? Time will tell. This chart shows that the Australian share market is historically expensive. trading at a forward PE ratio of more than 18 times. At these levels, investors are not buying a cheap market. This chart shows that the US share market is historically expensive, with the Shiller PE ratio almost 42 times, having only traded higher during the dot-com boom. At these levels, investors are not being rewarded to take risk. Alternative assets remain high conviction in our portfolios given their potential to provide downside protection and diversification benefits relative to expensive listed markets. But we need to be very selective and focus on both risk and reward outcomes. We favour core private credit, private infrastructure, hedge funds, private equity, and venture capital in our client portfolios. Private credit and private infrastructure yields have outperformed listed markets over the long term with less volatility, as have selective hedge funds. Private equity markets have also outperformed listed equity markets over the long term with less volatility. We believe that investors will be rewarded with higher returns and a smoother investment experience by investing into private markets rather than public listed markets. The orange bar in this chart represents the yield from US private credit, which is currently around 9.1%. There is a yield premium compared to public listed credit markets, and we believe investors are being compensated sufficiently for holding less liquid private credit. In addition, there are also diversification benefits and protection against higher inflation and higher interest rates in private credit. There's been a lot of negative press about private credit markets, and we agree that some private credit has a high risk of capital loss. This is why fund manager selection is important, and MPW undertakes significant due diligence on our managers to ensure that they're focused on both risk and return outcomes, in addition to being largely senior secured against assets of the borrowers they lend money to. Private infrastructure includes assets such as utilities, airports, data centres, renewable energy facilities. These assets have defensive characteristics and can act as a strong inflation hedge. The chart on the right shows private infrastructure returns since 2009, with the grey bars being cash distributions and the blue bars being capital growth. Even during the two large recessions in 2009 and 2020, private infrastructure protected investor capital, with income largely offsetting capital losses. Demand is growing rapidly across most private infrastructure sectors, particularly global data demand and the need to build data centres to supply this increasing demand. The chart on the right shows the outperformance from private infrastructure compared to listed infrastructure over the last 20 years, which we expect to continue. Private equity in purple has outperformed global listed equity markets in grey by around 4% per annum over the last 20 years, which is significant on a compound basis. We also like that in the large drawdown years of 2008, 2011, 2018, and 2022, private equity did a much better job of protecting capital compared to listed markets. To summarise, the outlook is uncertain. Higher inflation is the key risk to markets. However, AI tailwinds and strong corporate earnings are keeping investors bullish and markets grinding higher. In addition to the opposing forces of inflation and AI, there is still heightened geopolitical risk with the war in Iran and the threat of much higher oil prices a reality. After such a strong 3-year run in listed markets and with valuations looking stretched, it should not come as a surprise to see a 10 to 20% market pullback at some stage later this year. In the current environment, we continue to favour alternative assets and private market strategies. We hope that you found this update informative, and we thank you for taking the time to listen in. Please contact your advisor if you would like to discuss your investment portfolio in more detail. Thank you.